The closing bell rang exactly 15 minutes ago, and it is Tuesday, June 9th, 2026. Let's get straight into the closing print because the scoreboard today is just ugly. The Nasdaq Composite cratered 3.5%, settling at 25,529.9909.
Yeah, heavy damage.
Right, and the S&P 500 tumbled 2.1% down to 7,340.69. The Dow dropped 546 points. If you're just glancing at the index level, it looks like a total systemic bloodbath. But we are pulling the internal strategy scripts and the market breadth data today, and well, the volume confirmation tells a very different story.
It absolutely does.
Because underneath those headline numbers, more individual stocks inside the S&P 500 actually went up today than went down.
Which is wild. I mean, we're looking at one of the rarest mechanical anomalies in modern trading right now. You have this massive index-level liquidation happening at the exact same moment as a very quiet, highly targeted buying spree.
Yeah.
Our mission for this deep dive is to dissect that internal data. We need to figure out exactly what the smart money is doing into the close. We're looking at how algorithmic trading amplified this whiplash, and most importantly, what specific technical traps are set for tomorrow's opening bell.
Exactly. But to really grasp the severity of this afternoon's key reversal, you have to look at how aggressively positioned the market was this morning.
Yeah.
The setup was basically a heavily compressed spring.
Right. The early session was pure optimism.
Yeah, the S&P 500 was grinding up roughly 1%. Crude oil was cooling off, trading below $90 a barrel. The whole driving narrative was pricing in a U.S.-Iran de-escalation. So portfolios were levered up for prolonged ceasefire. It was like carefully building a house of cards in a quiet room.
And that heavy topside leverage is precisely why the reaction was so violent. Because midday, that macro narrative flipped in an absolute instant.
Right.
President Donald Trump posted on Truth Social, confirming that Iran had shot down a U.S. Apache military helicopter over the Strait of Hormuz.
Which obviously changes everything.
Exactly. The pilots were successfully rescued, but the statement included a very definitive warning that the United States, quote, must, of necessity, respond. Now, in the financial markets, the certainty of a military response instantly triggers a global repricing of risk. The quiet room got its door kicked open, and the wind just blew the house of cards everywhere.
The coiled spring snapped back. We saw that repricing instantly just hollow out the order books. I mean, look at Apple.
Oh, Apple's a perfect example today.
Right. They carried massive momentum from yesterday's WWDC, the whole Apple intelligence reveal. But every ounce of that buying pressure was just evaporated. Apple completely reversed to close down 1.89% at 301.54.
And the semiconductors got hit even harder.
Yeah, Micron Technology. It opened at 4.2% as buyers were just aggressively chasing Monday's bounce. Then the headline hits, and Micron reverses violently to close down 7.5%.
Right, so you're talking about a nearly 12% intraday swing on a mega-cap tech company. That reveals the actual mechanics of modern liquidity. Because when geopolitical news breaks, human traders aren't the first ones reacting.
No, it's the machines.
Exactly. Natural language processing algorithms scrape the headline, they identify the military keywords, and they instantly pull their buy orders. And when the bids disappear, the floor just vanishes.
But the real risk here, in assuming it's just algorithms, I mean, we see algorithms overreact to headlines all the time, right? Especially during these low-volume summer trading sessions. So how do we know this wasn't just, a 30-minute machine tantrum?
Because of the volume confirmation.
Right. It's easy to point at a headline and assume panic, but do we have the actual data to prove this was a true high-conviction liquidation event rather than just algo noise?
We do. The proof of institutional conviction sits right in the futures market volume. We didn't just see a slight uptick in selling pressure. The S&P 500 E-mini futures volume absolutely exploded to a massive 1.70 million contracts.
Wow. 1.7 million contracts is pure institutional weight.
Yes.
That is definitely not retail traders panic selling on their phones at lunch.
No, not at all. That volume print confirms that large-scale risk managers stepped in and actively faded the morning rally. The sheer size of that order flow triggered a cascading avalanche of stop losses.
Right.
If you look at the strategy notes from the trading desks, they highlight heavy sell-side imbalances right on the market on close print. They were securing cash and hedging aggressively into the final bell.
But that massive volume print presents a really fascinating puzzle for you as an active trader. Because if institutions were dumping 1.7 million E-mini contracts, you have to ask what specific assets were they actually selling?
Well, the cap-weighted benchmarks were punished.
Right. But as we established at the start of the show, the equal weight market breadth remained incredibly resilient. The internal data shows this phenomenon the strategy desks are calling a reverse divergence.
Yeah, and a standard divergence usually occurs when a handful of massive tech stocks drag an otherwise weak market to new highs. But today, the math completely inverted. The cap-weighted benchmarks were held entirely hostage by mega-cap tech.
Because of the heavy index weightings.
Exactly. Look at NVDA. NVIDIA alone dropped 3.4% today because companies like NVIDIA and Apple hold such a disproportionate mathematical weight in the S&P 500 and the NASDAQ. Their sell-offs completely dictate the trajectory of the index.
It's like a giant cruise ship. If the mega cap tech stocks drop the anchor, the ship itself violently stops moving.
Right.
But if you look closely at the tech, all the individual passengers, which are the smaller equal weight stocks, they're still running forward. The selling we saw today was a highly targeted tech execution. It was not some blind systemic liquidation of every asset class.
No, capital didn't evaporate. It rotated. Institutional investors definitely fled high multiple growth stocks, but they didn't just default entirely to cash.
Where'd they go?
They moved into defensive safe havens, utilities, real estate, and consumer staples.
And the strategy behind rotating into consumer staples rather than just sitting in cash is crucial for you to understand, especially with tomorrow's macro data looming.
Definitely.
Moving entirely to cash exposes a portfolio to inflation risk. Institutions need a place to park capital that guarantees a yield and, defensive stability, regardless of geopolitical shocks in the Middle East, because people are still going to buy coffee and peanut butter, regardless of foreign policy.
Exactly.
That makes a company like J.M. Smucker a highly targeted bunker.
And the financial results today justify that rotation perfectly. J.M. Smucker reported earnings, delivering $2.77 earnings per share on $2.27 billion in revenue.
This crushing expectation.
Crushing them. In the middle of a massive tech bleed across the broader market, SJM surged 10.4%. We also saw capital rush into idiosyncratic deal-driven safety plays. Nuvalent soared 39.2% today, purely because GSK agreed to acquire them for $10.6 billion.
But the resilience of those equal weight stocks creates an obvious question. If the broader market held its ground and capital is clearly still deployed in the system, why are institutional desks so terrified to buy the dip on tech?
That is the big question.
I mean, if NVIDIA drops 3.4% and Micron drops 7.5%, you would typically see value hunters stepping in, but they aren't. To understand why their hands are tied, we really have to look at what the options market is currently doing to institutional risk models.
Right. The reluctance to buy the tech dip isn't just about today's helicopter headline. It is entirely dictated by the technical fragility lurking beneath the surface. Volatility data is flashing severe warning signs right now.
Yeah, let's talk about the VIX.
The VIX spiked to a 9-week high near 23.00 immediately after the midday headline hit. It eventually settled down to close at 18.36, but the strategy notes we're looking at emphasize that implied volatility remains heavily coiled.
The primary structural threat identified in our sources is that the market has entered a short gamma environment. Specifically, we are sitting at a negative $12.1 billion net gamma exposure, or GEX. So let's make sure we're mapping the mechanics of this correctly in plain English for everyone managing a portfolio.
Sure, let's break it down.
If I am an options market maker, my goal isn't to take a directional bet on the stock market, right? My job is to provide liquidity, sell the options contract, and keep my trading book risk neutral. I balance my risk to zero through delta hedging, which basically means mechanically buying or selling the underlying stock.
That is the core mechanism. In a normal, positive gamma environment, market makers buy when the market dips and sell when it rallies. This naturally suppresses volatility and keeps the market calm.
It acts like a shock absorber.
Exactly. But in a short gamma environment, the mathematical exposure inverts.
So in plain English, you're saying the options market has essentially rigged the system so that if prices drop just a little bit more, the big players are mechanically forced to sell, whether they want to or not.
That's exactly it. When the geopolitical headline hits and the S&P drops, your risk models are suddenly screaming. Your downside exposure increases with every dollar the market falls, forcing your automated trading algorithms to mechanically short the underlying stock just to cover your own risk.
I literally have to sell into weakness.
You have to. And because every major options dealer is trapped in the exact same mathematical bind, their collective hedging creates this doom loop of selling. The initial geopolitical shock forces the dealers to short the market, which pushes prices lower, which
Which forces them to short even more.
exactly, it acts as an aggressive volatility accelerator.
Wow. Knowing that these algorithms are mechanically forced to sell into weakness, the strategy sources actually outline a highly specific battleground for tomorrow morning. The absolute critical level sits on the SPY ETF at 735.00.
The 735.0 level on the SPY is the trapdoor. If the market breaks below that price, the options dealers' risk models will breach a critical threshold. They will be forced into a massive wave of automated, aggressive selling. The internal desk projections show that a break of 735 triggers a cascading avalanche of sell orders straight down to the repair support zone.
And where is that zone?
It's located between 732.27 and 730.54.
And for those of you tracking the broader index, the S&P 500 index itself has a swing low of 7,334. That is highlighted as the absolute last line of defense before a total structural breakdown occurs.
Yep, 7,334 is the line in the sand.
So we know exactly where the trapdoor is located. Now we have to analyze the macroeconomic catalyst arriving tomorrow that has the power to either spring that trapdoor wide open or trigger a massive rescue mission.
And that catalyst hits right before the bell. Wednesday morning at 8:30 a.m. Eastern Time delivers the May Consumer Price Index.
The CPI print?
Yeah. The market is staring down a geopolitical powder keg on one side and a major macroeconomic inflation report on the other simultaneously.
Which creates an entirely binary outcome for the opening bell. A hot inflation print, meaning consumer prices rose more than expected, validates the fear that interest rates will stay elevated.
Right, a hot print acts as the fundamental hammer that shatters that 735 SPY support level. It will instantly accelerate the short gamma sell-off we just modeled out. The algorithms will flood the tape with sell orders, completely overwhelming any remaining dip buyers.
But the mechanics of a cool print are just as violent in the opposite direction.
Well,
If inflation comes in lower than expected, we don't just see a slow, relief-driven rally. We see a structural short-covering squeeze.
oh, massive squeeze.
Because all of those options dealers who were forced to heavily short the market today to hedge their downside risk, they'll suddenly find themselves offsides. As the market ticks higher on cool inflation data, their algorithms will be mechanically forced to buy back all of that shorted stock.
And that forced buying creates a rapid unwinding of hedges. The internal models project that a cool CPI print could violently snap the SPY back toward the 744 level as oversold tech gets bought up aggressively.
But what are the desks actually pricing in?
While the institutional consensus is heavily skewed right now, strategy desks are currently pricing in a 65% probability of downward continuation tomorrow morning.
So they're respecting the technical damage.
Mm-hmm.
The geopolitical shock trapped a massive amount of early warning dip buyers today, and those traders will likely use any opening rally as an opportunity to sell and just break even.
Exactly.
With this macro danger looming, our sources provided two highly specific day 2 setups for you to watch tomorrow. The first one builds directly on the reverse divergence we analyzed earlier. It's JM Smucker, ticker SJM.
Right. SGM is currently positioned as the premier defensive rotation long. It is exhibiting elite relative strength. As institutional capital continues to flee high multiple technology and semiconductor stocks, it requires a yield-bearing destination.
It needs a home.
Yeah. The technical setup here is a momentum continuation play. If you require a defensive hiding spot while the macro dust settles, the smart money is pointing directly at SJM breaking above Tuesday's high.
But the second day 2 play is considerably more complex. It really highlights the friction between underlying business fundamentals and macroeconomic panic.
Yeah, Oracle.
Oracle, ticker ORCL. Oracle fell 4.61% today, closing at 212.32. But they report their Q4 earnings tomorrow after the closing bell. Ahead of this print, Bank of America aggressively raised its price target on Oracle to 240, specifically citing incredibly robust demand for Oracle cloud infrastructure.
And the thesis circulating on the trading desks is that today's broad market sell-off has essentially de-risked the entry point for Oracle. You have a stock dragged down nearly 5% by a geopolitical headline, but its core business cloud infrastructure capex is supposedly accelerating.
Right.
So institutional buyers might look at this artificial pullback as an opportunity to front-run a massive earnings beat at a discount.
But here's the pushback. If you're an active trader looking at Oracle dropping 4.6% right before an earnings print, how do you separate the actual health of the company from the geopolitical panic dragging the whole sector down?
It's tough.
How do you isolate the variables? Like, Is Oracle dropping because of internal CapEx concerns, or is it dropping purely because an algorithm sold a basket of tech stocks when a helicopter went down?
The institutional flow data strongly suggests the latter. The broader market panic created an artificial discount on a fundamentally strong cloud asset. However, stepping in to play an earnings print in the middle of a negative gamma environment carries immense volatility risk.
Yeah, because even if Oracle reports a flawless quarter, a hot CPI print and further geopolitical escalation could drag the entire index and Oracle right along with it, straight through the trap door.
All right, so let's pull all these threads together. We started with a highly constructive, leveraged morning session that was completely vaporized by a single geopolitical spark over the Strait of Hormuz. That intraday whiplash exposed the hidden fragility of the cap-weighted indexes, proving how dangerously reliant the benchmarks are on just a handful of mega-cap tech stocks. Yet beneath that surface-level destruction, the equal-weight market breadth survived. Capital didn't vanish. It sought the yield and safety of defensive sectors like consumer staples.
Yeah.
But that rotation leaves the options market wound incredibly tight. We are sitting in a negative $12 billion gamma hole, just waiting for the Wednesday morning CPI data to dictate the next violent mechanical move.
The sheer speed of today's reversal leaves you with a critical, lingering question to mull over before the opening bell tomorrow. We watched a single military incident communicated via a social media post instantly get scraped by algorithms, triggering millions of futures contracts to be dumped, well, not dumped, but aggressively sold, which then forced options dealers to mechanically short the broader market.
In a matter of minutes.
Right. So if billions of dollars in market capitalization can be rewired in seconds without a single human making a fundamental evaluation, are we truly investing in the underlying cash flows of these businesses anymore? Or are we simply trading the mechanical speed of the news cycle? Keep your eyes locked on that 735 level on the SPY tomorrow and stay incredibly nimble.